Good morning and welcome back to the latest edition of the InvestTalk market analysis for the week ending December 22nd, 2023. Appreciate you all tuning in, liking and subscribing to this channel as well as our podcast InvestTalk. Now today I'm going to title the video the S&P. What did I title the video? I know I titled it S&P Resistance Levels Bring Year-End Pause. There we go. That's the title of the video. And Merry Christmas, first off, to all of you out there, hence why I'm wearing the red shirt. And we're going to dig into the charts. So that's what the S&P resistance level that I speak of focuses on. But we're going to first talk about the economic data, okay? And I start off with the housing starts. That came in on Monday. And obviously, that's a leading indicator to the overall economy. But I wanted to zoom out and show you all going all the way back to the 1950s and how many homes are typically built. Now, if you put a line through this, we are pretty much the long-term average, right? Kind of in that 1.5 million homes built mark. But what's even more interesting is that if you look post-financial crisis, look for about a decade post-financial crisis, all the way up until, we didn't get to 1.5 million homes until right before the pandemic, right? So you were underbuilding homes for nearly a decade. And that's part of the reason why we have such a low inventory, tight supply, and really a housing crisis across the country. Now, there are other factors that go into this, right? People that are locked into low mortgage rates, they're not selling the Airbnb or vacation rental craze, et cetera. That's certainly part of it. But the main reason why we don't have enough homes is because we haven't built enough, right, over the last decade plus, since the financial crisis. So I wanted to show you that nice tick up over the last, let's go to a one-year chart, over the last few months, and that is obviously a leading indicator and positive for the economy going forward. The Kansas City Fed Manufacturing Production Index, that one came in at -4. So that's now 4 months in a row. And this is the December number, so it's pretty live. And obviously the manufacturing industry remains relatively weak. Now, the housing market is going to get a bit of a boost going into next year. Why? Because mortgage rates now are down to the lowest levels since June. And that's going to bring some buyers off the sideline. I'm seeing in the jumbo market, you can get as low as kind of 6. So things are, we peaked out right around 8 in some instances. So we've had 100 to 150 basis point drop in mortgage rates, and that will bring some buyers off the sideline. And frankly, probably won't change the seller dynamic very much. Overall, we are just short houses, and the home price correction is just going to be a slow slog lower, not a crash like '08, just kind of, as I've been saying, just a slow slog lower. Now, consumer sentiment, that one picked back up, and obviously there's probably a few factors. One is financial conditions eased. Interest rates fell, and so mortgage rates fell. People are feeling a bit better about the overall economy. And, it's not great, but something not a lot of people are talking about. This was a pretty interesting report that came out this week. Durable goods, that improved a little bit. Last month was negative, kind of a snapback month this month. And this is probably the most important indicator. This came out on Friday. This is PCE. And we look at the year-over-year index. Let's start with this. This is 3% year-over-year, so higher than the Fed wants. But what they spoke about recently at the Fed meetings is that if you don't look at a year-over-year basis, but on a 6-month trailing basis, inflation is at its target. And you can see here, let's go back 6 months. 0.1, 0.1, 0.3, 0.1, 0.1, and 0.2. So if you add those together, 6 months, all those what I just listed off, that is 1% on a 6-month basis. So you annualize that, you get a little over 2%, pretty much at the Fed target. Okay, so that's what the Fed is speaking about. That is why the Fed is pausing and saying, hey, the trajectory of inflation is lower. Now on a 6-month basis, it's at our target. So if you continue to get that, then we're actually going to be under shooting our inflation target. So that's why they pause and they're talking about Fed rate cuts. And that's what the market is priced in here. So the first Fed meeting will be January 31st, end of January, and about a 14% chance of a cut. Probably not, especially based on the economic data so far, financial conditions easing so dramatically over the past 2 months. It's unlikely they're going to cut in January. Now, March is more likely. There's an 80% chance of a cut by March. March, that is basically 3 months from now. I think it's a little aggressive, to be frank. May, there's a 80% chance of 2 cuts by then. Look at this. We're at 525 now. There's basically the market has priced in zero chance that the Fed rates will be the same today as they are in May. That's a pretty stark move from where we were just a month ago. Look at a month ago. There was a 40% chance by May we were going to be flat, right? Continued pause. 43% chance there would be 1 rate cut by May. Now, there's a 73% chance there'll be 2 cuts by May. So that is a huge move in what the market is priced in. So, the question is, do you want to fade that? Basically saying, are those rate cuts going to be pushed off? I think it's a decent bet. Okay. Now, this is important as well. You can see the dollar, really since the beginning of November, is kind of front running this. Talk about how when the Fed announced it, the market had already moved on this. Now, move further, which I'll show you in a minute, but the dollar weakening since the beginning of November was kind of front running the fact that the Fed has paused and will be embarking on a Fed rate cutting cycle. And look, this is the trade weighted dollar index. And so if you look here, we'll go to the charts now. You look at the 10-year. The 10-year is now below 4%. Okay. Now, that's probably a bit aggressive once again. But a lot of this was positioning. The hedge funds were very bearish bonds, bearish treasuries. And as soon as we hit the 5% mark, this pulled back all the way to 4.9. So, this is this is something that will certainly drive markets. We know that the Fed policy is going to drive markets and volatility. And that's what's interesting this week is that volatility did peak up. We had that sell-off on Wednesday, which I'll show you in a minute, and volatility increased, and we didn't break below. So I'll be interested to see if this starts an uptrend. That is going to be negative for risk assets. It's going to be negative for risk assets. And let's pivot over to the S&P right now, which I'll zoom out to a weekly chart. Let's go to a weekly chart. And what you can see here is we are at the highs from the beginning of last year, January of last year. So that's that resistance. So not a shock to see this kind of pause, and you saw that pullback on Friday. Now what you can see here, this is what we call a bearish engulfing candle, this red candle on volume. I'll go to the SPY, and you can see this is on pretty good volume, okay? On pretty good volume, and we haven't closed above it. So until we close above it, this is what we call a micro bearish pattern. It's very small. Right? It's near term. It's not something that's changing the broader pattern, which is certainly an uptrend, very strong. But what you can see is we're overbought. The market's overbought, clearly. Bonds overbought. Asset prices in general are overbought. But that doesn't mean that the market has to roll over. Typically what happens, overbought conditions from a longer term perspective are positive. Overbought conditions typically consolidate, pull back modestly, work off that overbought condition, and then suddenly things can improve from there, right? And you go to new highs. And that's likely the case here, okay? Is some choppiness maybe into year end. Maybe this is the start of a little bit of a pullback. Do you refresh it, say the 50-day moving average? That's common. And you can see here, let's zoom back out, right? So once we got into past the banking crisis in the spring, we were in a solid uptrend going into the summer, and pretty much we found support here at the 50-day moving average. Again, we found support at the 100-day moving average once we kind of got there, and we rallied from there, and then we broke it in the summer. And let's go to a weekly chart. And what you can see is we found support at this 50-week moving average, okay, and reversed. And this is the opposite of what we recently have. Look at this weekly bullish engulfing, and we marched higher from there. So this generally isn't an uptrend, but you can have micro patterns that bring a pullback in the short term. So don't be surprised if that happens, okay? What else do I want to get to? Let's look at gold. Gold has certainly moved higher and looking to break out. This pulled back on a little bit more hawkish Fed statements going into the Fed meeting, and then the Fed meeting happened and we broke out, and now we just continue to kind of make headway. If I want to look at this, GDXJ to the GDX, the junior miners. So basically what this is showing is if the junior miners are outperforming the bigger miners, that's more money flowing into the riskier names in the space. And when that's happening, when money's flowing into the riskier names in the space, that is an indicator that you're in a bull market, okay? If people are worried, right, money's flowing out, it typically flows out of the riskier names, right? People aren't worried, people are getting more bullish on the space, money's flowing into the riskier names, and that's what's happening right now. So I wanted to show you that real quick on the gold market, and it's likely means that higher prices are ahead. Let me look at the broader NYSE, going back to equities. And zoom back out here. And this is also at resistance. See this breakdown candle here? That is also resistance. So you're getting into resistance levels on the NYSE, on the S&P, even on, I believe, the NASDAQ is there as well, right? The NASDAQ is at this crucial juncture. Let me clean this up here. Let me cut that. Let me cut that. So what you had back here on the NASDAQ was an uptrend, and that rolled over, okay? So see how, there's a pullback, you choppy period, and then you move higher. And that kind of continues to happen in an uptrend. That's why I talked about you can have broader uptrends, you have modest pullbacks to refresh things, get sentiment not so overbought, not so bullish, and then you get to new highs. That's what happened consistently really through 2020 and 2021 for the NASDAQ. And then you had a breakdown. And typically when you get back to those breakdown levels, that is resistance. And that's where you're at now on the NASDAQ. And that is probably why you continue to see the growth to value ratio in a downtrend. This week was positive for growth over value, but you saw on Friday that rolled over once again. So it's just showing classic downtrends and why a classic downtrend, lower highs, lower lows. You get little rallies, but those rallies tend to be pretty meek. And that just shows you that we're entering this new phase of value over growth once again, and small caps over the S&P. So there you go. So this is IWM to the SPY. SPY was outperforming in a slowing economy. And basically what happens here is when the economy when growth in the economy is slow, and that was post-financial crisis, there wasn't a lot of economic stimulus, then money flows into the growthier names because it's starved for growth. The market wants to find the companies that are increasing their earnings, that are doing well. And when the underlying economy is kind of weak, they tend to go for the growthier names. But when the dollar weakens, interest rates come down, and it signals that the future growth of the economy is going to improve. Because that we can remember, when the dollar is weak, that means our products and services are cheaper for the rest of the world. That is good for more domestically focused companies like the small caps. And therefore, earnings growth on those small caps and the more cyclical names go up. And that money starts to flow into that space. And so that's what you're seeing as of late. Is saying, okay, the dollar's weakening, the Fed is no longer on the neck of the economy, and there's so much fiscal spending, both with the CHIPS Act and the like, but also with interest payments on the debt. We've talked about this before. There's so much debt out there. The Obama tax cuts were $700 billion. That sounds like a lot of money. Sorry, not tax cuts, stimulus, Obama stimulus package. post-financial crisis, $700 billion. That's money that was spent flowing into the economy. Right now, the interest on our debt is $1 trillion. So every year, and that is fiscal spending. Most of that debt is owned by domestic savers, investment houses, etc. And those are dollars flowing into the system. Therefore, it's like a stimulus package every single year. So as long as you don't have fiscal or monetary policy on the neck of the economy, being hawkish, the fiscal policy is going to take over, and you're going to see pretty good economic growth. And that's what you're seeing right now, and what the charts are, I think, telling us. Okay. Now let's take a look at the credit markets. I always look at short-term junk to short-term treasuries, and what you can see is this is an uptrend. When this is an uptrend, it's risk on. Now, I will say there have been some pretty decent sell-offs intraday, even on Friday. This could be a near-term indicator. If this starts to roll over, that obviously risk assets, there might be a risk-off kind of period in equities. Let's look at some of these sectors. KBE, this is regional banks. Those continue to do well. I think those will continue to be correlated with treasuries. If the IEF 10-year Treasury ETF does well, I think those banks are going to continue to do well. What else? Industrials continue to just power higher. This is more of a consolidation phase here. You did get that sell-off, and I'll be interested to see if this can close above that Wednesday high. So if it does, that will just show you the strength, relative strength in the industrials. And I'll show you that XLI to the SPY, and that's starting to get starting to enter an uptrend. This is just a consolidation phase, likely for that next move. So I'm liking the cyclicals. I'm liking the small caps. I'm liking gold, obviously. Materials, basic materials. That one, those are strong as well. Look at the strength there. I'll go to IYM to the SPY. I always love these ratios. It just shows you kind of that near-term relative outperformance. That's starting to get an uptrend. It's not as powerful as the industrials, but I'll be watching that to see if there's a breakout. I like that space as well. Let's see, anything else? Energy. Energy, we have the Red Sea issues and potential geopolitical tensions, but overall, this is kind of neutral now. It's been improving, but not as much as I would like to get the energy prices up. Supply has been better than it has been expected, and that's what's brought oil prices down. But if you get the Red Sea issue, go look it up. There's basically Houthis that are attacking ships in that area. That's going to change the way that oil moves around the world and potentially tighten supply, and something I'll be watching as we go into the new year. And I think there could be a spark there geopolitically in January. So something I'll be looking out for. I think that's about it. Appreciate you all tuning in to this channel, liking and subscribing, and a reminder that the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell security or to participate in investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Have a wonderful weekend and a wonderful Christmas.